Next up, I'd like to welcome Mark Weedon. So he's joined us in 2016 to lead the research function at Property Partner, previously head of residential at the global index provider FSCS. He also manages our relationships with IFAs and institutions as well, and is on the committee of the British Property Federation. So without further ado, Mark, please. And it is this one for the slides.
Good evening. Thanks so much, Jake. Thanks so much, Alan. Always a difficult act to follow. I see you've worn a tie. Rob and I elected not to. You've upstaged us in every way you possibly can. But lovely talk.
Because we're here at a high-priced lawyer, I thought you'd all be wearing ties.
I think I did last year. Just get it wrong every time. Okay, so what am I going to talk about? Well, the residential property market. What's been happening? What might happen? And residential property is an investment class. What's it returning for investors like yourself, indeed people who've been in for a longer term, and how are they accessing that? And how does it stack up against the other things they're investing in? Well, what we have here to start off with is simple price growth. The year for 2016, we see in the larger blue bars the annual result to the end of each month. So you see that to the end of December there, the annual price growth, according to the Land Registry House Price Index, that's based on actual transactions, was 7.2%. On a monthly basis, it was pretty steadily strong. In the first half of the year, we had the referendum, as you all know, and things went a bit quiet in the summer. Not that much happened, but prices didn't really fall. And then towards the end of the year, they began to pick up again. So notching back up to a 7.2% annualised level by the end of the year. So far this year, we've got the two little indicators on the right-hand side there from the nationwide house price index. Land registry results aren't available yet. So we see a little uptick so far in January, which is traditionally a fairly slow month seasonally, and a bigger increase in February. So the signs are that although prices have slowed from the extremely rapid growth rates we saw of the last few years, they are still ticking up very steadily and they are still rising very strongly. We'll see how that compares to other asset classes. What about rents? Well, again, the larger blue bars, they show you an annual figure, and a little green one down at the bottom, that's the rate for each month. And straight away, you see on a monthly basis, on an annual basis, residential rents are incredibly stable. This is a private rental price index, according to the Office of National Statistics. They're measuring tens of thousands of properties. And you can see that by the end of the year, rents in the UK had increased on average by 2.2%. So that's that underlying income growth that Alan was talking about. There you go, there you have it. It's about 2% a year. For residential property, it was 2.2% over the last 5 years, and we believe that trend is fairly accurate for the longer term as well. So even if your yields are compressing, your income is still increasing underneath that. And what that means by the yield compressing is just that your prices have gone up by more. So if you're an existing investor, even though your income return's gone down, actually, who cares if your if your cash in a tin's gone up and your price has just gone up by a bit more? More on that to come. What about on a regional basis? Well, we're ever trying to become more high-tech at Property Partner, and we've moved to the heat map presentation of the regional analysis here. And you see on the left-hand side those regional price changes. Perhaps you can not quite make some of those out with the little grid lines on the screen there. But what we see, interestingly, is London at 7.5% price growth was only a fraction above the national average of 7.1%. That's a fact that's unheard of since before the financial crisis. London has just been knocking the rest of the market away on average for the rest of the year. And the reason for that is that prime central London really has slowed down to a much lower level of activity. Its prices aren't really growing there. And that's almost entirely due to factors like the stamp duty escalator that they brought in a couple of years ago, the additional stamp duty there, and indeed the referendum, where some foreign investors have questioned whether they want to be in London anymore, and central London was very much the area that they focused on. The rest of London, outside that sort of prime central core, has continued to perform much more strongly, perhaps along the rest of the Crossrail route, that kind of thing that we like to focus on, still delivering outperformance, and that's what's kept it up just above the average at 7.5%. In terms of the rest of the country, as is so often the case, we see the south outperforming the north on general, the east at 11.3%, the top performer, the northeast, the bottom in England at 4.1%, and Scotland the lowest of all. But fairly steady around the southwest and the Midlands, and the northwest at round about the 7% level. How about rents? Well, let's see. These have increased universally across the country. 2.1% in London, again, just below the average this time, which was 2.2%, and stronger rental growth in the southeast at 3.3%, the east at 3%, up towards 3% in the southwest and even the East Midlands, and then lower in the north of the country. So, yet again, as so often been the case, it's a bit of a reversal in the London story, but still the north-south divide evident in 2016, although perhaps not quite such disparity as we've seen in the past. So what's actually happening on the ground in the housing market last year and now? Well, there's a lot of talk in the press about activity really slowing down, a lack of supply, and that's very true, but it's important to look at this from two aspects, and one of those is transactions. And what you see here is the month-by-month level of transactions, and actually that really hasn't dropped at all. So in spite of a lower amount of stock coming to market, people are still somehow doing just as much business. The appetite among owner-occupiers and investors is still there. Demand is still very much there. They just don't have quite as much to choose from. And in fact, the last few years, we've seen transactional levels in England up at just over 1 million per year, which is way above the trend that we've seen since the financial crisis, where we saw lower levels of transaction for a number of years. And it's not since 2007 where we saw levels of well over 1 million, 1.2, 1.3 million in England itself. And actually, if you look at the very useful RICS residential sentiment survey that they release every month, they report directly from a selection of about 500 surveyors what's going on in the market. And they will tell you that the number of properties currently available listing on an estate agent by estate agent business basis has dropped to 44. That's down from a long-term average of about 70, and it's dropped very quickly over a period of a few years. So there really is a genuine lack of supply in the market at all levels, and whoever you are as a buyer. But the demand's still there, helping to explain what's happening with prices. And just how serious is that lack of supply? Well, of course, if you're an investor, it means you haven't got as much to choose from. There's more competition. It's helping support prices if you're an existing owner. But what about if you want to live in the UK, if you want to rent? And some quite stark analysis, really, in terms of the actual supply shortage on the ground in this country. And I'm going to have to try and explain these graphs because they are somewhat complicated. We'll start on the left. What that line graph is showing you is on a year-by-year basis how much available stock there is in the market, if you like, on a household-by-household basis. So, in other words, in 2008, in the whole of England, in terms of the number of households, there was 4.4% worth of stock left to spare. There was a little bit of room to wriggle, a little bit of choice if you wanted to move, but not very much, and a little bit less so in London at 3.8. We know that that is well below the European average. Across the whole EU, all 27 countries, including countries far, far poorer than the UK in the east of Europe, the average was we're about 10% below that. We're 14% below Germany, and a similar level, 17% below France, so significantly below countries that are on a more of a par to us economically. That's just a trend that has continued to get worse and worse and worse, particularly in London. So by 2016, the housing shortage is not a myth. It exists in London. There are 3% fewer dwellings in London than there are households. People are being forced to come together and live together, multiple families in one dwelling. People are being displaced out of the capital, and at the very bottom end of the market, more people are becoming homeless. So it's real, it's happening. In England, there's 2.1% wriggle room. The heat map on the right-hand side shows you that deep red concentration in London, where the problem is it's most acute. And the different degrees of red away from that give you an idea of, in each local authority, how serious the shortage is or isn't, if it's a much lighter colour. So essentially, it is a national problem. It's so severe in London. Unsurprisingly, the government are trying to target this as one of their main manifesto policy agendas, and it's certainly something that needs to be addressed. But what does it do? Of course, it puts a very strong, solid bedrock underneath prices, because as long as you've got an extreme over demand versus supply, you're always going to have people bidding those prices up. That's what we saw with those transactions, and that to an extent helps to explain why prices have been so stable in residential property over the long term. What about rents? Well, what the rents depend on. If you look at this graph on the right-hand side, you see residential rental values in the blue. Aside from a little dip after the financial crisis in 2008, they have followed an almost identical trend to wages and to inflation, general prices going up in the economy. And on an annualised basis, that little table down on the right-hand side, you see that over the 12 years in focus here, UK residential rents have increased by 2.1% a year. That's your income growth that Alan was talking about. In the last 6 years since the downturn, it's been 2.4. They've actually outperformed wages and inflation over that period. So what's it telling you? It's telling you, first of all, that you are getting good income growth in the long term, but also that your income stream is not volatile. It is linked to economic fundamentals, and it is growing along with economic fundamentals. So it's protecting you against inflation, and you're not so much subject to the successes and failures of companies, the whims of politicians, etc., etc. This is underlying trend activity that is going on in the economy at the grassroots level. On the right-hand side there, we see the proportion of household income spent on whether it's rents or mortgages. It covers both, simply to illustrate that this has barely changed at all in the last 5 years. There's so much noise in the press around affordability of housing. We do have a shortage. Housing is expensive in this country, but it's actually not getting any worse. Rents are not really increasing any more quickly than other prices and wages in the economy. Let's look forward. Hopefully, we had a budget last week, and as a result, the government's the Budget Office, they released their annual statistics, the Office of Budget Responsibility, and they issue a 5-year projection for key economic variables and asset class prices. So they're predicting that GDP, that's economic growth in the UK, is going to increase by 19% in total on a nominal basis over the next 5 years. They think earnings will go up by 16.5%. It's a fairly steady annual rate of growth. You see the different colours there, the little blocks showing you which year is which. Inflation, well, I don't think there's going to be anything like as much inflation as economic growth, so that's real economic growth. We see a gap of about 8% there at 11.3. Onto the residential property values, rents up at about 19%, again continuing to outperform wages and inflation. So we are expecting further long-term income growth in residential investment. And what about prices? Well, the trajectory looks set to very much continue as we've seen. Price growth of around about 5% per year, taking it up to nearly 26% in total. So on this evidence, you would expect to see a continued similar pattern of performance that we have done, strong, stable total returns made up of a good balance between capital return and income growth. Commercial property, we've also put that in there for comparison, down at around 4% because they're expecting prices to actually fall in 2017 for commercial property, i.e. shops and lovely office buildings like this one. Just on the right-hand side, this isn't a cumulative, it's just an indication of where they think interest rates are going to be at the end of each year, to show that, as Alan said, they are not expecting interest rates to rise by any material degree at all. So, in other words, if you're investing in something now, which is outperforming savings rates, interest rates by quite some margin, the expectation is that it's going to continue to do so, and investors are going to have to continue to look elsewhere for yield. They're not just going to be able to go back to savings and bonds because interest rates aren't going to go up very much. So, the asset class. This is an old favourite of mine, as is the next one. A number of you have probably seen it before. The blue lines are showing you that over the long term, residential property has outperformed year after year core asset class of equities, hedges in commodities like gold, and of course savings in the green line at the bottom there. The annual rate of total return for UK residential has been 10.4% on average over a 20-year period to the end of 2016. Cash savings 3.7%. FTSE All Share at 6.7%, gold at just under 6%. London residential, much higher still. You'll notice that those lines for property are nothing like as jagged. They're not going up and down as much. Prices are stable, income's stable. It's much less volatile. What does that mean? It means that your risk-reward is superior because you're not so much subject to the risk of when you might invest in the market cycle. If you invest in equities when prices are very high and then you sell when it's very low, then you've suffered at the worst hands of what volatility can do. But if something is just increasing steadily over time, you don't have that volatility, you don't have the same level of risk. So towards the right-hand side of this chart, the volatility, the risk is much lower, and you see that actually residential property as an investment has not been much more volatile than absolutely risk-free cash savings in the UK. What about return? Well, the higher up you are, the higher your return is. So in fact, at the top right-hand side of this chart, UK residential property and London property has outperformed those other core asset classes by a high degree at a lower level of risk. So your premium has been pretty significant on an annual basis. That's a long term, 20 years, 2016 as well. Right now, what are you getting in terms of income? Well, market-wide, we've calculated the average net income for residential property. Buy-to-let, if you like, that represents the majority of the market. We think it's about 3.5%. Equities just below that, based on the whole of the FTSE all-share at 3.2% in terms of their current yielding. And cash savings, you can still just about clobber together 1% if you really go out of your way to get the best deals, but that seems to have slowly notched down since the base rate fell to 0.25%. So on a weighted average basis, if that was your portfolio, you would have an income yield of about 2.2%, with residential being the highest performing. Okay, so what are people investing in residential property? Well, rather more than you might think, considering that buy-to-let residential property investment is not a professionally managed asset class. It's a cottage industry where 98% of the £1.3 trillion worth of private rented accommodation in this country is owned by buy-to-let landlords. The majority of buy-to-let landlords own between 1 and 3 properties. Large institutions who own hundreds of properties, well, even like Property Partner, we're effectively a large institution by that scale, they are owning a tiny 2% of the overall market. But buy-to-let is huge. £1.3 trillion, £1.2 trillion. Within that sits £1 trillion worth of equity. That's household wealth, £1 trillion worth invested into residential property. Out of that total pie, we see pensions remaining the largest asset class at 42.1%, 2.2 trillion, cash savings at 32.3%, just under a third, and equities in terms of direct holdings of equities by investors at 6.1%. So residential property firmly in third place, the third biggest asset class in the household portfolio. If you break down pensions into the underlying asset classes, you see that cash savings becomes the biggest part at the bottom there, followed by equities up at almost a quarter. Properties the same, because there's no residential properties in pensions at the moment, and bonds at 15.6%, and any other alternatives, including commercial property, at just under 8%. So essentially, in spite of the professional investment community having given them no help, no information, no vehicles by which to access it, the great British public have gone out on their own and accumulated £1 trillion worth of residential property in their investment portfolios. It's delivering £42 billion worth approximately of income into the economy every year. It's a major driver of income in employment, etc. And it really does matter. So we think it's extremely important as barriers to entry in the direct sector increase. The government have messed around with taxes. They're removing mortgage interest rate relief. It's very difficult now to borrow money to do buy-to-let if you want. There's an incredibly acute shortage of supply. It's difficult for independent, non-professional investors to actually access that. We think it's important to help people access this asset class and continue to be able to get this allocation that they really need to build that diversified balanced portfolio. So that's essentially what we're offering. We hope that we can continue to grow and offer it to a lot more people by using technology to break down those barriers and doing all the things that we do. We're finding the stock, we're investing it, and we're offering liquidity. And Rob's certainly going to be covering a lot more of that. Where are we right now? Well, at this exact point in time, 363 properties, individual units on the platform. We've got over £60 million worth of stock there now, £49 million of equity invested by you good people, and, well, 10,000 in total. Over £1 million in dividends and 12 million traded on the secondary market. So liquidity has been working pretty well too. Thank you very much.